Hi, everyone. Thanks so much for joining us today. I'm Caroline Woods. Today, we're going to be talking about ETFs and really balancing optimism and pessimism when it comes to investing. Joining me for this conversation is Matthew Bartolini, head of SPDR America's Research at State Street Global Advisors. Matt, thanks so much for being here.
Yeah, thank you for having me.
Excited to get our conversation going. But before we actually get started, we just want to remind the audience that we want to hear from you. So please be sure to ask your questions in the chat. Also, please answer our poll question, and we'll refer to those answers in just a bit, those results. We want to know what you think is the biggest risk to the market's rally right now. But Matt, let's get started. Kind of set the stage for us, if you will. You know, we're talking about balancing optimism and pessimism. So tell us why investors should be confident in investing right now, but also cautious.
Yeah, so I think part of it is the market so far has been marked by some narrow leadership, and that leads to some caution because only roughly 26% of S&P 500 stocks are actually outperforming the market. If we look over the last 40 years, that's the lowest hit rate ever. It's well below the historical average of 48%, but it's also below what we saw in 98 and 99 leading up to the dot-com bubble, where it was about 28 and 30%. But the market still has double-digit gains. It's been able to navigate declining earnings throughout the entire year. We've also been able to sort of perhaps mitigate some recessionary fears. And if we look at some of the economic data, even though if we look at the leading economic indicator, which has been in decline for 10 consecutive months, there's some more caution. There is some courage to go along with it because you look at the labor market and it is inherently very strong. We have the employment to population ratio basically at highs not since 2001. You look at GDP reports and we saw the consumer really driving overall GDP growth. And we know that that's a large portion of our economy. And then even today, retail sales came out and really shows we have a resilient consumer. So we do have this sort of optimism, pessimism type struggle going on because there are reasons to be a little cautious with that myopic leadership. But also, economic data continues to support that the resilient consumer can perhaps add enough strength to sort of usher this economy through a little bit of a slowdown.
I think that's the thing, regardless if you're in the cautious camp or if you're in the this market's only going to head higher camp. I think one thing that can be agreed upon is this market, economy, consumer is very resilient. But you have kind of an interesting perspective in your role because you actually can see what's going on in terms of ETF investing, in terms of inflows, outflows, buying behavior. What are you seeing on that front, and what is it signaling to you?
So really it's caution, some hesitancy, but also some shallowness, some weak breath. Because when we look at fund flows, we don't just look at the totals, which continue to be positive, which speaks to sort of a secular growth of the ETF industry. But we look at the depth of flows. In last month, in month of May, roughly about 42% or so of ETFs had inflows. Historically, that number is around 63%. So even though the flows from a numerical perspective were positive, there weren't a lot of ETFs that were actually in net inflows. And if we go back to say 2001, when the market was up double digits and there were significant gains, roughly we saw about 72% on average that year of ETFs having inflows. So that weak breadth is not just from a market gains perspective, it's also what is receiving investment. The other part, when we look at it and we break things out by sectors and asset class, on a year-to-date basis, fixed income ETFs have taken in the same amount of money as equity ETFs, roughly about $92 billion each. The big difference is that equity ETFs, the total AUM is around 5.7 trillion, but in the fixed income space, it's only 1.4 trillion. I say only, but it's 1.4 trillion. So relatively speaking, while the numerical numbers are the same, around 92 billion, the relative positioning shows that more money on a relative basis to assets is going into fixed income. And within that fixed income, the asset, the subsector has been the ultra short duration government bond ETFs. So again, these flows sort of show a little bit of hesitancy, caution, to really not fully buy into the rally. Now, since the month ended in May, we've seen a little bit in June, and overall, we start to see a little bit of a beta chase.
Well, I was going to ask about that because when you actually look at the S&P sector breakdown in terms of month-to-date performances, we are starting to see some sectors that had underperformed. It's not just necessarily this AI tech rally anymore this month. We've also seen some small cap outperformance. So that broadening out a little bit. Obviously a few weeks doesn't make a trend, but you aren't necessarily seeing that reflected in the ETF buying behavior just yet.
So it's just a little bit in June. So in June, large cap U.S. equity exposures have taken in inflows. Our lineup has benefited just given the sort of liquidity nature of it. But to me, when I see those flows, some of it is just sort of beta chasing. The gain's been so strong, and a lot of folks have been caught off sides because there had been that lack of investment, that have been sort of the store of value and cash allocations. Obviously, money market allocations were supremely elevated entering the month, but also been stockpiled throughout the year. So we're seeing a little bit of that gap closing. But still well below what you would say a full-throated conviction buying behavior from a mass amount of clients.
You talked about more money going into fixed income, but in terms of equities, where are you seeing the most buy-in? Because every day we talk about this tech and AI rally, but what are you seeing on your end?
So we look at sectors in the aggregate. Sectors are in net outflows this year, and over the last few months as well, which to me speaks of the risk type of market. If you have inflows into sectors, that's an active risk view. So because sector ETFs haven't had inflows, that's sort of a dialing down of active risk. Where we've seen inflows in a very concerted way are quality exposures. Quality ETFs have taken in record amount of inflows. I think in the past 2 months, they've either had their best inflow and then their second best inflow month ever, which sort of speaks to this idea that we've talked a lot about, because we have declining earnings, is trying to move up in quality a bit. And we started to see that come through in some of the ETF fund flows. The other part is on the equity space, where there's been really strong relative positioning, has been into the international equity arena. International equity ETFs are basically taking in the same amount as US equity, even though the asset differential is very large. So there's a lot of strong relative positioning going into international, with a specific acute focus on a regional specific basis to Europe.
Okay, you mentioned risk. Speaking of risk, just a reminder to our audience that we want you to take our poll. I see some results coming in terms of the biggest risks to this rally right now. Looming credit crunch and over tightening by the Fed seem to be in the lead, but keep continuing to answer that poll so we can hear from you. Also, please ask the questions that you would like Matt to answer. We'll try to get to as many of those as possible. We definitely want to hear from you. But Matt, just in terms of looking ahead to the second half of the year, I want to talk about some investing strategies that you would recommend. But given what you've been seeing, this more cautious, quality-oriented approach to the market, what do you think is in store for the second half of this year? Because right now we have an S&P up 15% and a NASDAQ up 30%.
I don't think we're going to see the continuation of those gains in the 15 and 30%. I don't think it's going to be a carbon copy of the first half when we get to the second half. And I think part of it is that narrow leadership. A foundation built on a few pillars can be somewhat unstable if one of those pillars starts to shake. And we look at those stocks that are leading the rally, valuations are starting to become a real concern, even just on an individual stock basis, but broadly on the S&P 500, it's trading above its price to earnings ratio. And again, that earnings figure continues to decline, and we see weakening earnings sentiment where there's still more downside revisions than there is upside. So if there is, if all of a sudden Chair Powell said July is a live meeting, if that's a really live meeting and all of a sudden you get another 25 basis point rate hike, that could really spook the market. And if there's only a handful of stocks and gains, I think that could really drive a lot of negativity out. So I think it's going to be more choppy than anything else. I don't think it's going to be a straight hockey line stick like we've seen so far. There's going to be a lot more, I would say, fundamental-led volatility in addition to some of the macro risks that we've already seen, which is why, from our point of view, that in the U.S. specifically, you want to really move up the quality spectrum. You want to own those firms that have more sustainable cash flows, more quality balance sheets, and the ability to sort of have low earnings variability, because earnings are becoming more in question. Obviously, once we go into July, we're going to hit the Q2 earnings season. And I think that's going to be a big earnings season because it could be the third consecutive of negative year-over-year growth.
Okay, I want to continue with those investment strategies in just a second, but you talk about not seeing a carbon copy of this 30% gain year to date, seeing more choppiness. What does that choppiness actually look like in terms of market declines?
Well, I think We haven't had a significant amount of day-over-day volatility. Like last year in 2022, the percentage of days that the S&P 500 rose by up or down 1% was, I think, at all-time highs, and it sort of speaks to the negativity in the marketplace. We're not going to go back to that. I think you do have, again, I think we're going to skirt any recessionary pressures because of the strong labor market, resilient consumer. So I don't think the NBER is going to come out and say, yep, recession. So I don't think that's going to be that much of a headwind. But I do think you're going to see a little bit more of a downside skew associated with some of the day-over-day returns. So I wouldn't expect massive drawdowns or technical corrections. I just don't think you're going to see these days of big upside moves led by a handful of stocks. I want to see more breadth associated with the market rally to say that the sustainability of the gains that we've seen so far are going to continue in fruition throughout the rest of the year.
Okay, so sticking with some of your investment strategies, in addition to moving up in quality, kind of that return to quality fundamentals, you also say people should rotate overseas away from the US. Why is that?
Well, quantitatively, if we look at it through traditional academic sort of quant factors, valuations are one of those. And valuations in the US, as I mentioned earlier, are not attractive. They trade above the historical price to earnings, price to book, what have you. Overseas, the valuations on a relative basis are supremely attractive. Trading, on a relative basis in the bottom with 30th percentile, for instance, if we look at developed non-US stocks. And that's really what I mean too on rotating overseas is developed ex-US, not emerging markets, because valuations are constructive and supportive in emerging, but earning sentiment is not. Earning sentiment is weak. Expected earnings growth in EM is negative. There's more downside revisions than upside. But in the developed ex-US space, particularly in Europe, upside revisions are greater than downside revisions. Growth is expected to be, I think, like in the 6 to 7% range. So you have positive earning sentiment, you have positive or constructive valuations, and international equities are up double digits as well. So there's a strong return momentum. So we like the international space for those reasons, more so than in the US.
All right, we have a question from Leslie wanting to go back to some of the flow data that you have. She says, what's been going on with small cap flows? And, I had mentioned that we've obviously seen outperformance from the Russell. Not so much today, it's pretty flat, but it's up about 6.5% this month alone. So what have you been seeing there in terms of flows?
So at the end of May, small cap was in net outflows in a big way. It was pretty weak, pretty porous. And that really reflected what we've seen from an earnings sentiment perspective. Again, I keep going back to this. In small cap, there's far more downgrades than upgrades, and earnings expectations for 2023 are looking to be negative for small cap equities in the US. Large cap equities is looking to be about plus 1%, so still not great, but not negative. So small caps, the return momentum has also been weak. Small caps have vastly underperformed large caps. And I think it speaks to the myopicness of this rally where it's been the mega cap stocks. However, all of a sudden in June, and again, it's still early days, we're only the 15th of June, small caps have had pretty significant inflows. I think roughly around 4 billion in the month of June. So a little bit of a reversion. Part of this, though, I think is a little bit of dip buying because valuations in the small cap space were in the bottom 1 percentile and are relative to large caps over the last 15 years. But again, sometimes things can be cheap for a reason. However, I will say also there's a little bit of a nuance in some of the small cap flows that roughly about 2 billion of those flows, so about 4 billion out of 2 billion, are actually from our funds because we merged a fund. Again, this is like more inside baseball, but it was a $2 billion fund. We merged with another fund, and that only gets recorded as an inflow, not an outflow, because the merged fund is gone. So, you always have to sort of look beneath the surface, which is one of the things that we always do, and we're always happy to share that information. Also, if anyone wants to go in depth on how a fund merges, we're also happy to talk about that. It's actually a lot of fun.
You're skewing those numbers on us. We appreciate the inside baseball talk. All right, so going back to the strategies, moving up in quality, rotating overseas, you say seek income opportunities. So you obviously like some dividend pairs, but also balance risks with bond ETFs.
Yes.
Do you think that bonds are a better place to be than stocks right now, given kind of your cautious tone?
Yeah, so I mean, even just looking at the earnings risk premium, so the yield on the S&P 500 minus the yield on the U.S. Treasury, it is well below historical medians, and that indicates subsequent returns for stocks to be relatively weak historically, and then that's been a persistent trend throughout time. Stock valuations are elevated, while bond yields are elevated, meaning their valuations are constructive. If we look at the ag, its yield is in the 80th percentile historically. So you can get, roughly around, 4.5%, 5% yield on bonds. And on the ultra short space, that I think is really sort of a potential sweet spot, because in the 1 to 3 year corporate bond space, you can get roughly around a 5.2% yield, but you're only taking on around 1.8 years of duration. And you're taking on about 88% less volatility than stocks. But the yield on the S&P 500 from an earnings perspective, its earnings yield is around 5%. So you're getting a higher rate of cash flow in 1 to 3 year corporate bonds, but you're taking on significantly less volatility. And that's how we think about sort of balancing these risks, is that in that ultra short space, you can get a yield premium of duration, or a yield premium of volatility is the metric we like to look at, on the 1 to 3 year corporate bonds that is better than any other portion of the sort of traditional fixed income market, whether it be high yield or the ag or treasuries, from that perspective. So we like this idea of capturing that really higher yield on the short end of the curve and not extending too much in duration, because bonds have become more volatile as the return prospects have increased. And one of the things that we always like to point out is that the ag itself, the Bloomberg ag, its standard deviation of returns is roughly in the 99th percentile historically. So we've seen a larger amount of sort of elevated day over day changes. So to mitigate that, move down the risk spectrum and focusing on that ultra short space.
Okay, we have about 5 minutes left. So we just want to tell the audience, feel free to ask us any more questions that you'd like Matt to answer. Happy to get those in with the last few minutes remaining. But, you talk about these impressive bond yields. Where else you could get pretty impressive yields, at least so far this year, is the mega cap tech space and these AI plays. 4.5% is nothing compared to 100%, 170% returns that we've seen on some of these stocks. If we have some audience members here who have been sitting it out because they thought this first half of the year was going to be much rougher than it has been, and they have some FOMO, are they too late to the game for these mega cap AI tech rally?
Not on a long-term basis, because if you think about how AI is sort of embedded within a lot of different structures of our society, it is not going to be sort of a flash in the pan type of thing. And I think like the whole AI craze gets a little bit caught up in sort of the chat GPT-ness of it, that it's sort of, I saw an article today that they were able to, finish a Beatles song using AI. Like that's a more of a fun way to use AI that, is probably not, unless the Beatles are able to sell 1 million songs on it, not going to have like a significant economic impact. I think the actual true economic impact are on more industrial uses of AI, and not the sort of predictive text or asking it to create a recipe for you. Like those are productivity gains. But there are firms that use AI and algorithmic techniques to detect water treatment systems, and if there's going to be a leak within some of the manufacturing systems that they have within their own factories. So I think that's the big portion of AI that is going to be key in terms of how it manifests into economic activity and economic productivity. So a long-winded way of saying, no, I don't think they missed the boat, but I do think there's more diversity in who can benefit from AI, and in terms of who is actually using it to develop some of their core business processes. And again, there's a lot of the discussions we're having because of some of our innovative solutions and innovative strategies that we have that focuses on multiple industries using innovative technologies such as hypercomputing, hyperconnectivity, and robotics and AI.
All right. Well, bringing it back to ETFs, Leslie has another question. How are active ETFs changing the landscape of the ETF marketplace?
Yeah, I mean, active ETFs, they've taken in so many inflows this year. I think active equity ETFs have had 41 consecutive months of positive inflows, which is obviously a record. Overall active ETF AUM is around 460 billion. Roughly there. It's really strong. It's not your traditional stock picking alpha generators, trying to beat the S&P 500. That's really not where a lot of the growth in the active ETF flows have come from. Part of it's been derivative income funds focused on generating income by using options. The other part, so that's more outcome oriented. The other one are those defined outcome funds that are using an active ETF construct to provide upside and downside capture in a buffered format, and are using an active ETF construct because of the flexibility it provides in terms of the options role choice. So for me, when I see this happen, a lot of launches, a lot of flows, a lot of headlines around it, it just speaks to the adaptability and flexibility that the ETF structure can provide, but also the transparency, because a lot of the flows into the active ETF space have been into the transparent active ETFs. And the ability to do the due diligence on a transparency basis is one of the calling cards of the ETF industry. And so seeing really strong flows in active strategies really speaks to, again, that adaptability, the flexibility, but also the maturity of the ETF industry, where there's more depth and breadth of choice. And, it's just really healthy to see.
All right, so Matt, we're almost out of time, and I knew we wouldn't get to all of my questions. This went way too fast, but want to give you a final chance to hit on any other key points that you really want to drive home for our audience, whether it be ways to mitigate recession risk or other investment strategies that you have. Just a few, one quick final thought.
Yeah, so, this whole optimism and pessimism thing sort of comes back to the fact that the yield curve typically predates recessions by 6 to 24 months. The yield curve inverted in June of 2022. So fast forward now, we're probably at the midpoint of that window. So are you an optimist or are you a pessimist? And I think the ability to diversify those recession risks means, perhaps leaning into cyclical exposures that benefit from a resilient consumer, like home builders or transportation stocks, but then understanding that there could be some weakness because we have seen some economic activity, move sluggishly, whether it's the LAI being negative for quite some time. So, still sort of positioning defensively, and that could be going up in quality.
All right, we'll leave it there. Matt, thanks so much for your insights. We really appreciate it. Thank you, all of you, for joining us. Of course, thanks to State Street Global Advisors.